Dividend exchange traded funds are the ultimate form of passive income. You do your research, you do the upfront work, you invest in the ETF, and a paycheck just rolls in on a monthly basis. Today's video, we're going to be looking at the best ETFs that do pay on a monthly basis. Before we get into that, what is the benefit? So what is the reason to really have a dividend or an ETF that is going to pay you on a monthly basis? This is really when you look at living expenses, a majority of them are on a monthly basis. If you're paying your auto loan, if you're paying car insurance, your mortgage, you're paying everything on a monthly basis. So very similar to Social Security income, you're paid on every 30 days instead of every 90 days, which can be very convenient for not only reinvesting, but also for having those dollars that are coming in on a regular basis. So you can actually live a life or essentially substitute some of your income with the money that is coming in. Now with the reinvestments, if you're reinvesting the monthly dividends on a monthly basis, you are actually participating in DCA, which is the dollar cost averaging, is a very strategic way to invest in the stock market. And for me, it is one of my absolute perfect and really ideal ways to do this. So what I did with dollar cost averaging, if you caught my portfolio videos, we put money into a certain portfolio, which is a 4 ETF portfolio, every single week through dollar cost averaging. And this, of course, has yielded some really, really high returns. In the last 2.5 years, I'm up roughly 60% in the portfolio through dollar cost averaging, which was absolutely crazy. So let's go ahead and get into the 6 best monthly dividend ETFs that we have out there, starting with number 1. And this is one that we've seen before, the JP Morgan Equity Premium Income Fund. That is right, this is the JEPI. We've done a video on this a little while ago. This one is a large cap equity and covered call options. Now that is something to remember when it comes to kind of the risk and how risky you kind of want to get with it. JEPI has a really good, strong track record of performance, and overall it pays a pretty decent amount at a 7.5% yield is a really, really good return. And of course, for the monthly payouts, this is the largest fund of its size. It is 179 million. So that is right. I believe that would be in millions, about $33 billion that is in this fund. And again, looking at size-wise, this is just absolutely massive because people like the ability, again, to get that monthly paycheck. Now, the expense ratio on this is a 0.35, so still a very low expense ratio. Number of holding, 120 holdings. So again, when it comes to individual stocks that are paying roughly the same when it comes to dividends, this one holds a ton of companies. So even if 1 or 2 underperform or some overperform, you're going to be really risk mitigation because you do have these. Now, of course, thanks to the impressive 30-day SEC yield of this of a 6.98, 33 billion, like we said, in total assets, which is kind of crazy. This, of course, is very, very good because the fund's goal is to deliver S&P returns with lower volatility plus that income factor. Now, of course, the equity linked notes is the thing that we are talking about. You have to be careful with this because what it does is there are a little bit of volatility with this because it is covered called strategies that they use. And I believe when we looked at this before, it fluctuates between like 7 to 12% of the fund itself. So the money in the fund itself that they do these cover calls, which does give it a little bit more of a risk aspect of there. But when you look at the holdings such as Microsoft and Visa, some of the best stocks of 2024 are in JEPI, which is the reason why it is honestly probably the number 1 top choice if you're looking at an ETF that is going to perform and really perform well and also provide you income on a monthly basis. Second one we look at is the JP Morgan NASDAQ Equity Premium Income Fund, JEPQ. So a little bit different than the JEPI, the JEPI. This actually is the JEPQ. So very similar, large cap equity, covered call options. Again, very similar, the exact same expense ratio. Does hold 97, so it does hold 97 stocks. So this one mirrors the strategy of the JEPI, but it uses the NASDAQ 100 rather than the S&P 500. So again, do your research on this so you know exactly what the difference is. It really takes the strategy that we've seen in JEPI with the S&P 500 and applies it to the biggest and best NASDAQ ones that are in there to produce a bigger yield. But the bigger yield does come with a little bit more volatility. And of course, the yield in this one is 9%, guys. That is a massive, and the highest yield that we are going to see in this list, it is yielding 9%, which again is kind of crazy. But of course, those covered called options are making a big difference. Looking at number 3, we have the Investco S&P 500 Low Volatility ETF. Now this one holds, again, 101 funds. You can see different companies. We have JP Morgan, we have Investco, even have WisdomTree on this list. But overall, you can see kind of the overall, the arc or how they do this when it comes to income on a monthly basis. Now the SPLV, which is the ticker symbol for this, tracks the S&P 500 Low Volatility Index. This is a basket of 100 stocks within the S&P 500 that have the lowest volatility over the year prior. So this is going to change, and this ETF actually rebalances on a quarterly basis. So not only are you being paid out on a monthly basis, but this is actually changing exactly what it is invested in on a quarterly basis, which is a pretty quick and pretty heavy rebalance schedule. Now this one's the expense ratio is a 0.25, so a little bit lower than what we've seen in the other two. Now, of course, this one does possess the lowest yield on the list, but it is very, very safe and less reactive on stocks. It's very similar for people who can't suffer and don't like the huge swings of the market, but prefer to be invested in the market with equities over holding bonds in its entirety. Now, of course, some of the top holdings in here, we have Berkshire Hathaway, we have Coca-Cola, we have Colgate and Palmolive. So again, some really, really massive big names that we have within here. Looking at number 4, we get into the WisdomTree US Large Cap Dividend Fund. Again, very similar to all the other ones, except this one holds a lot more, guys. The other 3 were roughly about 100 stocks. This one holds 302 with an expense ratio of the 0.28. This one is the DLN, is the ticker symbol for this one. Includes large cap dividend paying stocks that are screened for quality. They are looking on the best quality stocks that we have within this large cap. And of course, looking to keep in factors like equity, return on assets, gross profits to assets, cash flow assets, and total risk return. Now this one, of course, producing a yield above 2% on average and also double-digit returns. So not only are you seeing the income generated from this, but you are also seeing double-digit returns, which is pretty good. With reputable stocks, it's carrying Microsoft, JP Morgan, Apple, Exxon, Johnson & Johnson in just the top 10, which again, it holds a lot of shares, holding a total of 302 within here. Looking at number 5, we have the WisdomTree US Midcap. So very similar to what we just looked like in the large cap. This is the mid-cap version of it to go ahead and produce that monthly income. And of course, this focuses around the mid-cap companies, and some of these names you might not heard of, but overall expense ratio of 0.38. And this is the DON instead of the DLN. So you can see how some of these companies kind of produce a couple ETFs that generally do the similar or the same functionality over a different market or maybe a different sector. So this one applies the exact same methodology as the DLN, but it does have a slightly larger expense ratio, which is a little bit higher, holds 333 different stocks. But overall, this one again focuses on the mid cap, which there could be a case to be made. Large caps growing maybe not as fast as the mid caps can. Same can be said kind of with the small caps and how they are kind of built out. Now this one owns Bistro Financial Services, Corebridge, Illinois-based Packing Corp of America. So it's a lot of those mid cap companies, not the huge names that you have and really in those heavy mega stocks and those heavy tech stocks, but overall still yielding a pretty good return. And the final one we look at is the Investco S&P 500 High Yield Dividend Low Volatility ETF. SPHD is the ticker symbol in this one. Now, this one only holds 51 companies. So again, when you're doing your research, make sure you know exactly what you're investing in, because 51 companies, some of those are holding 300 plus, some of those ranging around 100, but this really focuses on the S&P 500 high dividend, low volatility, with the goal of providing bond-like stability with a strong dividend yield. So pretty good in there. The index in the fund contains a tidy 50 groups of stocks, which is good. They go and they evaluate the top 75. Then they narrow it to 50 that they're going to have in here. Now, of course, yield-based weighted, the SPHD investors is very strong, average return of more than 4% over the last 5 years. Fund also has a broad sector diversification, double-digit exposure to utilities, consumer staples, real estate, energy, and healthcare. And this fund is very nice, very tech-heavy. Altria, Verizon is in here, Kinder Morgan. So a lot of these, again, being paid on a monthly basis for the dividends can make a very, very big difference. So investing in a monthly dividend, let me know in the comments if you guys think what you guys really do think of it. But bottom line is monthly dividends can provide a very solid, steady stream of income. But honestly, for my opinion, I would rather stick a little bit more long-term if you're going growth. When you're thinking, 10, 20, 30 years in the future, that's kind of point that you want to get to the growth factor. But when you start getting to retirement, the conversion going into having, the big growth to needing the income to essentially supplement Social Security and everything else, you can actually get something like this as a monthly dividend, as a supplement to the paycheck you're no longer getting from that 9 to 5. And over when it comes to living expenses, when it comes to reinvesting, and knowing that you're going to have a monthly paycheck for this can be very, very solid for a lot of different people. Again, when you start looking to supplement income and cover all of your monthly expenses that you have. So, all right, guys, so that is going to do it for the video. Let me know in the comments what you guys think, and I'll catch you in the next video.